Welcome to this explainer. Today, we're unpacking the literal mechanics of Pakistan's tax system. We're going to see exactly how the FBR is engineering the nation's revenue machine for 2026 and beyond. Let's get into it.
So our primary source of authority today is the Federal Board of Revenue, or as it's commonly known, the FBR. You can think of it as the central nervous system that oversees the entire taxation ecosystem in Pakistan. Literally every rule, every tax return, and every single digital portal we talk about today. It all rolls up to this one institution.
Here is our roadmap for today. 1. The Federal Board of Revenue. 2. The Digital Tax Revolution. 3. Inside the Tax Ordinance. 4. Defining taxable income. And finally, 5. The language of modern tax.
Section 1. The Federal Board of Revenue, the macro institution.
Now, the FBR isn't just one giant room of tax collectors, right? It's a highly compartmentalized organization. They really divide and conquer. For example, domestic tax collection is entirely separated under inland revenue, which handles your income and sales taxes. Meanwhile, border operations and trade tariffs are handled over by customs. But beyond just collecting money, they have dedicated wings for things like audits and compliance risk management, and, most importantly for our modern era, a specialized wing entirely focused on digital initiatives.
Section 2. The Digital Tax Revolution, modernizing the system.
Okay, the sheer volume of new digital services here is striking. We're not just talking about a simple website anymore. We're looking at a comprehensive digital ecosystem that is rapidly transitioning away from the old paper-based bureaucracy. You've got Iris, which is the central web-based system for managing your taxes. You have e-payment platforms for generating your payment slips or PSIDs. Plus, there's the track and trace system for enforcement, digital invoicing, and point-of-sale integration. It really highlights this massive, aggressive push toward mandatory e-filing and digital compliance for basically all taxpayers.
And these official digital facilitation centers are making compliance pretty seamless. Whether you're an overseas Pakistani managing property transactions from thousands of miles away, or just a local taxpayer filing your annual return, these portals are custom-built for instant online verification and electronic filing.
But all these new digital portals and tracking systems raise a really important question. If you buy something on a mobile app today, or say subscribe to a cloud service, how exactly does a tax law that was originally written way back in 2001 categorize that transaction in 2026?
Section 3. Inside the Tax Ordinance, the Rulebook.
To answer that question, we have to actually look inside the Income Tax Ordinance of 2001, specifically as it's been amended up to June 2026. You can really think of this table of contents as the source code of the nation's economy. Chapter 1 handles preliminaries, Chapter 2 maps out the charge of tax, which basically means who and what gets taxed, and Chapter 3 digs into the actual computation of tax on taxable income.
So the absolutely crucial point here is that understanding the structure of this document is the key to understanding your own tax obligations. The law doesn't just throw rules at a wall to see what sticks, it uses a very strict hierarchy. Chapters break down into parts, parts break into divisions, and divisions into hyper-specific sections to categorize literally every financial action you can possibly take.
And when things get a little too specific, they use what are called schedules. The law uses these sections right at the end of the text to outline highly specific, complex rules for niche sectors. For instance, the 7th schedule handles banking companies, the 11th handles builders and developers, and the 14th handles small to medium enterprises. It's a brilliant structure really because it keeps the main text of the ordinance uncluttered while ensuring absolutely no industry falls through the cracks.
Section 4. Defining taxable income, the core categories.
So, under Section 11 of the ordinance, the government basically chunks all possible earnings into these 5 distinct heads of income. It's incredibly straightforward. Number 1 is salary, your standard paycheck. Number 2 is income from property, like collecting rent. Number 3 is income from business. Number 4 is capital gains, say from selling shares or a piece of real estate. And number 5 is income from other sources. That's kind of the government's catch-all bucket for everything else you might think they wouldn't notice. The whole goal here is ensuring every single penny has a designated legal bucket.
Now, the law makes a massive distinction regarding exactly how that income is taxed. There is literally a world of difference between an active taxpayer and a non-filer. If you're an active taxpayer, your name is on the official active taxpayers list under Section 181A, and you get to enjoy standard tax rates. But if you're a non-filer, well, you don't just fly under the radar. You become subject to the dreaded 10th schedule, facing much stricter rules and significantly higher withholding rates on your everyday transactions. The system is intentionally designed to heavily penalize noncompliance.
Section 5. The language of modern tax. Updating the glossary. If you have ever bought something on a mobile app or a website, this exact legal definition of e-commerce added to Section 2 is what applies to you. It explicitly covers the sale or purchase of goods and services over computer networks using methods specifically designed for placing orders. Basically, this is how the government now officially sees and taxes your late-night online shopping sprees.
But what if you aren't actually buying a physical good? What if you're paying for Netflix or cloud storage or even a remote doctor's appointment? Well, they've introduced the term digitally delivered services for exactly that. This ensures that subscriptions to streaming audio and video, online software, e-learning, and telemedicine, basically services requiring minimal human intervention, are legally categorized, locked down, and totally ready for taxation.
And to capture the middlemen, the giant tech platforms we use every single day, they now legally define an online marketplace. This includes interfaces that facilitate interactions between buyers and sellers for a fee. And crucially, it applies even if the platform itself doesn't actually own the goods being sold. The platform itself is now a recognized, completely taxable entity in the chain of commerce.
Okay, let's dive into the enforcement side of these modern definitions. The law now explicitly targets the offshore evader. That's someone who hides assets outside of Pakistan and underdeclares them. But it goes a step further. It also targets the offshore enabler. Those are the advisors and accountants who actually help people design these evasive transactions in the first place. It shows a complete zero-tolerance approach to modern, borderless tax evasion.
As we wrap up this explainer, seeing the immense lengths the FBI has gone to, updating their physical infrastructure into digital portals, and writing things like algorithmic settlements and e-commerce directly into the text of the 2026 ordinance, it leaves us with one really provocative thought. The government is obviously racing to digitize its revenue collection, but as things like artificial intelligence and decentralized finance completely accelerate over the next few years, is this rulebook going to be enough to keep pace with the future? Thank you for watching, and keep questioning the systems that shape our world.